welcome to the deep dive. So, you're looking to get that credit score up, maybe even quite a bit, right?
Yeah, a lot of people are. It feels like this constant puzzle.
We've been digging into Chapter 6 of Credit Mastery by Derek Booker, and he makes some pretty bold claims.
He really does. Talks about potential jumps of, 100 to 350 points, which sounds, almost too good to be true sometimes.
Exactly. So today, our mission is to unpack the strategies he lays out, the actual actionable things you can do.
It's about understanding the levers, what actually moves the needle based on how these scores are calculated. It's less mystery, more mechanics.
Okay, let's jump right in. Booker says the absolute #1 factor, the heavyweight champion, is payment history.
Oh, absolutely. Non-negotiable. It's like the biggest piece of the pie.
He stresses that even one slip-up, one late payment, can really knock you back.
It can. And conversely, just consistently paying everything on time month after month builds such a solid foundation. It shows reliability.
That steady track record is gold, basically.
Pure gold. Lenders see that consistency and it tells them you're a good bet.
All right, second big one. Credit utilization. How much of your available credit you're actually using.
Right. This one trips people up sometimes. It's not just if you pay, but how much you owe compared to your limits.
Booker suggests aiming really low for the fastest results, like under 10% if possible. Definitely under 30%.
Yeah, under 30% is the standard advice, but pushing below 10%, that's where you can see quicker gains. He also mentions a neat tactic.
The multiple payments thing.
Exactly. Paying down the balance before the statement closing date, maybe even a couple of times a month.
So the reported balance, the one the credit bureaus see, stays low even if you're using the card regularly.
Precisely. It keeps that utilization percentage down snapshot by snapshot. It's quite strategic, actually.
Right. Interesting. Now, what about credit mix? Having different types of credit.
Right. So this is about showing you can handle various kinds of financial responsibilities, not just credit cards, but maybe an installment loan too.
Like a car loan or a student loan, something with fixed payments.
Yeah, exactly. Or even a mortgage. Lenders like to see that breadth of experience. It suggests you're, financially versatile.
So if you only have credit cards, maybe looking into a small, manageable installment loan could potentially help your score.
Potentially, yes. If managed responsibly, it adds that different type of credit experience to your report.
Makes sense. Now, for people maybe starting out or rebuilding their credit, Booker talks about specific tools.
Yes, secured credit cards and credit builder loans. These are really foundational tools.
How do they work, basically?
Well, a secured card, you put down a deposit, usually equal to your credit limit, so it's a low risk for the lender.
Okay. The deposit secures the line.
Right. And a credit builder loan is often structured so you make payments and then get the loan amount at the end. Both are designed purely to help you build that positive payment history.
Gotcha. Just demonstrating good habits over time.
That's the core idea, building that track record.
What about becoming an authorized user on someone else's card? That sounds like a shortcut.
It can be a quick boost, yeah. If you're added to an account that's old, has perfect payment history, and crucially low utilization,
You sort of inherit that good standing.
you benefit from their positive history, exactly. But there's a big but.
Uh-oh. What's the catch?
If the primary cardholder messes up, runs up the balance, misses a payment, it can drag your score down too. You're linked to their behavior.
Right. So choose your primary cardholder very wisely.
Very wisely. It's
Yeah.
got to be someone you trust implicitly with their finances.
Good heads up. Booker also warns against something people might do automatically, closing old credit cards they don't use anymore.
Yes, this is a common mistake. People think, I don't use it, I'll close it.
But that can backfire. Right. Why?
Two main reasons. First, it reduces your average age of accounts. Older accounts generally help your score. Second, it lowers your total available credit.
Which means your utilization ratio could jump up, even if your spending hasn't changed.
Exactly. Suddenly, the same balance looks like a higher percentage of your total available credit. So unless there's a compelling reason like a high annual fee, keeping old, unused cards open is often beneficial.
Okay, good to know. Lastly, he mentioned something called a rapid rescore. What's that about?
This is more of a specialized tool. Let's say you pay off a big chunk of debt, or you get an error corrected on your credit report.
Right.
Normally, you'd wait for the next reporting cycle for that to maybe impact your score. A rapid rescore is a process often initiated by a lender, like a mortgage broker, to get your credit report and score updated much faster.
So you can see the positive change reflected in days, not weeks or months.
Potentially, yes. It's useful if you're, say, right on the cusp of qualifying for a better loan rate and need that score bump quickly.
Interesting. So wrapping this up, the big picture from Booker seems to be proactive, be strategic.
Absolutely. And consistent. These aren't really secrets, they're just understanding the rules of the game and playing it smart.
You really can influence your score, whether it's small tweaks or aiming for those big jumps Booker mentions. It puts the control back in your hands.
It does. It demystifies it. Your score isn't just a number that happens to you. It's a reflection of actions you take.
So thinking about all these levers, payment history, utilization, mix, and the rest. Here's something for you, our listener, to consider. What's one immediate action you can take, maybe even today, to start shifting your credit score in a positive direction?
Yeah, what's that first step?
Food for thought. Thanks for tuning in to The Deep Dive.